Welcome to this week's edition of Wealth Strategies Unleashed with Concenture Wealth Management. I'm Robert Gilliland.
And I'm Mike Alexander.
Thank you so much for joining us. You know, markets go up, markets go down, geopolitical crisis, you got the government, you got all these different things. Mike, should you be afraid of investing in this market?
Well, first of all, Robert, it's a great question. I don't think being afraid is really the way to enter any marketplace, but I certainly recognize the fact that there's a lot of things going on that can make people fearful. One of the things that I think we always find interesting is that anytime you read anything that's in the press, they're always talking about somebody being afraid of something. They're afraid of higher interest rates. They're afraid of recessions. They're afraid of geopolitical risk. They're afraid of a poor earnings report. People tend to be really, really afraid. And the only time they don't seem to be afraid is when greed is in place.
Well, greed's powerful, right? And this is what I know. In every type of market, in great markets, there are people who are losing their shirts. And in terrible markets, there are people who are making a killing. Our job today is to talk about these markets and what should you be doing. What are kind of some things that you are thinking about retirement, thinking about the lifestyle that you want to live and where things are. And you're always asking yourself, do I have enough? Should I be in this market? Should I be out? What are some things people should be thinking about right here, right now?
So I think right now, investors should really be thinking about, am I diversified in this environment? We've been in an environment, as you know, Robert, that there's just been a handful of stocks that have really propelled the broader indices. And, it's possible that a lot of investors simply don't own those. And so they're looking at their portfolio and they're like, I don't feel like seems like the market's doing a lot better than what I'm seeing within my portfolio. And my portfolio is balanced and this should be working better. The reality is that as we've talked about a lot, you have 490 stocks that in the S&P 500 that aren't working particularly well. You have bonds that aren't working particularly well either because the interest rate backdrop has been one where the central bank has been raising rates, and so I think a lot of people might be feeling a little left behind and maybe a little lost in this kind of environment, and so. I think we understand that. I think it's just an environment that happens every so often, but I think it's something certainly we want to pay attention to.
You said something earlier that I think it took me go back to 1998, 1999. And I remember sitting across from a potential client at that time who I've worked with now ever since then. And one of the things inside of their portfolio is they go, yeah, I've got a blue chip portfolio. Their portfolio, and he said that he was a moderate risk. Portfolio was 100% stocks. It was all the technology, or at that time, internet companies. And he said, these are all blue chips. I don't have anything to worry about. It was Intel, Microsoft, Netscape, all of these big companies at the time. Oh yeah, he did have one energy, and that was Enron. Inside there, it says, these are big blue chip companies. I have nothing to worry about. And then 2000, 2001, and 2002 happened, and the tech bubble popped, and they got completely destroyed at that time. Luckily, we started to go through to diversify. We were able to save him and get him recovered. But the reality is that I think really what you should be afraid of is over concentration, because given this market right here, and what's happened is that people have migrated towards those AI big tech companies that are making all the headlines, and not paying attention to those other industries that have opportunities.
Yeah, 100%. I think if you were looking at, some of the fastest growing companies in the United States, there's only one of the, what we call the Magnificent Seven. There's only one of those companies that's actually growing its earnings at 25% or more every year. There are probably 110 companies in the S&P 500 that are growing their earnings faster than that company. And so I think a lot of these have been overlooked because, one, they probably don't get a lot of the media attention. Two, I think there's perhaps some sensitivity around around where the economy is and whether or not, some of these growth rates are sustainable. But I think that's the environment that we've been in. And I always, I think we always talk to investors, Robert, about, how the index actually, works, that a lot of these are market cap weighted. So the more expensive a company or the more valuable a company becomes, the bigger the percentage of the index it actually becomes. And so I think the opportunity is perhaps a bit better than it may actually look like when you're looking on the surface, if you will. And kind of back to where we first started the conversation, it's typically fear that creates opportunity. And so I think some of those opportunities are there, whether it's in stocks or it's in bonds or it's in, emerging markets or what have you.
Well, you go and you think about this, right? You think about all these different points in history, specifically around investing. There's always a reason not to invest, right? There's always that reason. And generally speaking, when that happens is generally the time. Now, right now, we may have some sectors, some companies that are clearly overvalued. The reality is that some of these companies are not going to continue to grow at these humongous multiples year after year after year. If you were to go look, the Magnificent Seven, if you were just to take it at the face of it, really all what you're saying with the Magnificent Seven is they're the only earnings show in town. No one else, those 493 other companies, there's no growth inside of there. There's no long-term outlook inside of those companies. You just want to own these. And that's, if you're going to concentrate your portfolio, yeah, you should probably be a little bit fearful. But if you're going to have a long-term type perspective, then it absolutely makes sense to continue to own some of these. And there's no reason to be afraid. I also go through and think about this is that at times like these, where we have these huge moments of volatility, it makes a tremendous amount of sense to stop, re-gauge where you are, keep score, and evaluate your financial plan.
Yeah, absolutely. I think there's never really a bad time to be recalibrating or rebalancing your portfolio. And I think to your point, Robert, is taking a step back and saying, okay, I have this plan that's in place. Is it coming to fruition? Is everything working accordingly? Not necessarily on a short-term basis, but is the long-term plan still in place? Do I need to make adjustments? Do I need to make adjustments to the plan, or do I need to make adjustments to the portfolio? But what do I need to do to make sure that that they're working in lockstep with one another? Because again, situations change, and we're in an environment where I don't think people want to be chasing certain parts of the marketplace just because they think, oh, that's the place to be right now. It's really more taking a step back and making sure that, as long as I'm still on target relative to my plan, then I'm probably okay. And I'll wait to what we affectionately call reversion to the mean in the marketplace, which means, everything always finds its level, if you will. And I think that's the kind of environment that we're in, where it makes a lot of sense to go back and look at that.
Well, in kind of hearing you talk about that, a couple of things kind of come to mind that I think make sense, right? And that is keeping score and looking at the outcomes that you need or want to have happen. A lot of times when that greed kicks in, everyone wants more, right? But more isn't necessarily going to change your life, right? So more may mean that you're taking unnecessary risks. And there's no reason for you to take unnecessary risks inside of it. I think it also makes a tremendous amount of sense to evaluate your tolerance for risk. And I know you've seen this, when every single day the market's going up, and every single day it continues to go up, risks kind of seems to kind of disappear. People don't get nervous about the market's going up. Oh, this is great. But what's amazing is that their portfolio hits a new high. And then we have a pullback in the market, a significant pullback in the market, and they view that they just lost money. That feeling that you have that my portfolio, I started off with $1 million and it grew to 1.2. Now it's 1.1. I just lost $100,000. Well, no, the value dropped, but you didn't necessarily lose that. Making sure you have that long-term perspective in the way that you manage that money to be able to keep score. And if you're ahead of the game, take some chips off the table, rebalance, look at what your cash flow is. Because we've had the markets that for the most part this year started off very bullish. We've given some of that back, entered into some corrective territories. To rebalance that portfolio and make sure your cash flow is intact so you don't have to make decisions unnecessarily is what I think what gives people success when they're going back and looking at their financial picture.
Yeah, I think, Robert, everyone wants to be comfortable, right? And I think the idea is that there are many times that you're comfortable with what it is that you own. And then there are other times when you feel like you just don't own enough of the stuff that's really doing well. And then if you wait long enough, some of those things kind of come back down to earth, if you will. And it can happen very, very quickly. I think as we all have seen, it's not uncommon to see a company announce its earnings. And if they miss a number or don't guide the market higher, they might lose 10 or 15% of all of the value that they've ever created can be lost in a day. Now, clearly that's lost on paper, but it doesn't feel good. And I think that's kind of what volatility is volatility is this idea of this doesn't feel comfortable. It's almost like when you fly on a plane and the plane kind of either tilts or goes up, ascends or goes down a little steeper than what's comfortable. And sometimes that's the way that markets can feel. And I think for every investor, they just kind of have to, they kind of have to feel their way along, like what's my level of comfort? And it's different for everybody.
So what I'm going to do here with the few moments that we have left is that I'm going to throw some questions out to you and to get your response. One of the things that I'm hearing a lot from clients is they're fearful of the political environment here in the U.S., government shutdowns, the amount of debt, the amount of deficit, inflation, the Federal Reserve raising interest rates. Should people be afraid of that?
So I think the short answer is I think concerned is probably the better word, but I don't think these are anything that are new topics, if you will. I tend to view them as kind of political footballs that get tossed around. I think if you look at the U.S. government debt, there still seems to be a fairly significant appetite for U.S. debt, and that's on from a global perspective.
Meaning that when we are issuing debt or when the U.S. government's taking on more debt, someone has to loan that money or buy that debt. And there's still a strong appetite. There are still individuals, companies, and countries that are still interested in owning the U.S. debt or U.S. bonds.
Yes.
That's what you mean,
yes.
right?
And I think so. So, safety, if you will, or security, like we like to say in the bond market, is kind of a relative game. Do you feel better about owning U.S. debt or U.S. treasuries, or would you rather own the debt of France or the UK or Japan or any other place in the world? And so sometimes it's a relative standpoint. And as long as on a relative basis, people are more comfortable owning U.S. debt, then there's going to be a marketplace for that.
A lot of times when I'll tell people when they're talking specifically about the government, the amount of debt, and the lack of getting things done, is the question I ask people is, do you believe that the American dream is over? Because if the American dream is absolutely over, we have a whole different conversation to have. Maybe it's changed, but if the American dream is still intact, then we know what we need to do. And there's going to be periods of this of this volatility that we're going to have to make sure that we get you through, that we're going to have to make sure that you can still sleep well at night. That includes reevaluating the portfolio, making sure you're diversified. Next thing that's been the geopolitical world. Mike, a lot of people say, should I be fearful of what's happening geopolitically with everything from wars in Europe, wars in the Middle East, Taiwan, everything going on? Should people be fearful of that? And what does that mean to their portfolio?
I don't know if the answer is to be fearful of it because, being afraid, there's no real investable outcome in terms of, being afraid of things. But I think vigilant is maybe a good term to use. And that is to say that, it's not to suggest that things can't spin out of control. But we've seen this before. We've had world wars, we've had conflict, we've had geopolitical uncertainty, we've had terrorist attacks, we've had all of these various things. And, as we've said in the past, these are all the bricks in the wall of worry that markets tend to have to climb. And the reality is that companies and investors tend to adapt to those. But is there a possibility of something that's out there that we haven't seen or that we're not aware of? The answer is absolutely. Those things always exist, but they're not really investable.
I love that right there, is because I think a lot of times we want to say, oh, X happens, therefore do Y. And the reality is the extremes, these black swan events, World War III, we really, there's not an investable outcome. It's not like we can go to US dollars, go to gold, go to bonds, go to energy company. There's all different sorts of things that potentially you could go and do. And the reality is that we don't know what's going to end up happening. So there's not a way to properly invest for them.
I tend to step back and look at it this way, Robert. I think this is one of the things that we always talk with our clients about. And that is, no matter what happens, do I still have to make my mortgage payment? Is the electric bill still going to be due? Do I still need to buy food and gas? And if the answer to those, do I still have to pay college tuition? Because if the answer to those questions is yes, then I think I want to focus on the things I can control, and I want to be vigilant and understand the things that I can't, because maybe they'll help me to make better investment decisions. But at the end of the day, unless they're canceling all of those things that I owe money on, then I'm just going to have to grapple and adapt.
I think that's a great place for us to kind of put a period and stop and to wrap all of this together. If you are fearful about this market and all of the different potential things that could impact the market, it absolutely makes sense to have a conversation, to review your plan, to see if your plan is still on track, to evaluate your probabilities of success and make sure you're still comfortable with it. It absolutely makes sense to understand what the potential outcomes can be and see if you're good with that, and therefore go and make adjustments if something keeps you up at night. Because at the end of the day, you want to be able to live the lifestyle that you want to live. You've worked hard to make it happen, and making sure that you're being smart and aware. That being afraid doesn't mean you stick your head in the sand. Being afraid means you evaluate where you are, you evaluate what's happening, and you make adjustments inside of there. And with that, I'd like to say thank you to everyone for joining us this week on Wealth Strategies Unleashed. I'm Robert Gilliland, and that's Mike Alexander, and we will see you next week.
See you next week.